In this lesson, we're going to talk about the biggest single investment market in the world today, the stock market. And there are a lot of things that you have to learn and understand, which are basically inviolable, and which are laws and principles practiced by all people who make money in the stock market. So let's begin. When you begin to earn and save amounts of money in excess of your needs for short-term expenses and insurance, you will want to explore investing in the stock market. There are three major stock markets in the United States: the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. These stock markets are run by executives and boards of directors who come primarily from the investment firms and brokerages that trade on these markets. Stock brokerage firms are companies that come together in their respective exchanges to make a market for publicly traded stocks and bonds. You can buy and sell more than 14,000 different stocks, plus hundreds of mutual funds, through a stock brokerage firm, either live with offices like Merrill Lynch or online like Ameritrade and Charles Schwab. Most of the trading that you hear or read about in the stock market is in what is called common stock. A share of common stock in a company represents a percentage of ownership of that company. Ownership of the stock entitles you to share in the risks and rewards of that company, both the upside and the downside. Your ownership of a company is proportional to the number of shares that you own relative to the number of shares that the company has issued. For example, if the company has 1 million shares issued and you own one share, then you are entitled to 1/1,000,000th of the profits or losses of the company. When you purchase a share of stock, you actually become an owner of that company for as long as you own the stock. There are several important factors for you to consider if you're thinking about trading in the stock market. First of all, for you to buy a share of stock, someone else has to be willing to sell that share of stock. Every time a trade takes place, the seller of the stock is betting that the stock price will decline, or at least not go up. The purchaser of the stock is betting against the seller, believing that the stock price will increase. In this sense, stock market trading is a zero-sum game. Each purchaser or seller is betting his or her knowledge against the others. Unless your knowledge of the stock in particular, and the stock market in general, is superior to that of the people whose whole lives are spent working in the market, it's dangerous for you to believe that you can outguess them. The experts simply have too much time and experience for you to make better decisions than they do. You'll probably be better off in a mutual fund of some kind. Now, some of the most popular and largest mutual funds today, which I'll talk about a little bit more later, are called index funds. These funds purchase a cross-section of stocks in the Standard & Poor's 500, the Wilshire 5000, or a particular industry. These index funds almost invariably match the overall market in growth or decline. In 80% of cases, an index fund will outperform the smartest and most experienced investment managers of stock brokerages or mutual fund companies. Stock prices are largely determined by the expectations that the purchasers in the market have for the future profitability of the company issuing the stock. Since expectations are volatile and constantly fluctuating with every new piece of information, stock prices can change dramatically up or down in a matter of days or even hours. It's important for you to know that the very best financial minds in the world spend 40 to 60 hours each week studying the stock market and making investment recommendations. In spite of this single-minded focus on stock market values, more than 50% of the recommendations of the stock market experts turn out to be wrong. The very best you can say is that advice from financial experts is merely a series of educated guesses. Just to avoid making mistakes, much less to pick stocks correctly, you must spend an enormous amount of time and energy studying the market. You must study the individual industry within the market and study the individual company in that industry that you are considering investing in. Fortunately, with the internet, there is much more information available to you faster today than ever before. But you must still do your homework before you buy a stock. There are two well-known concepts in the stock market that you will hear about: contrarian theory and the greater fool theory. Contrarian theory says that the best time to buy a stock is when nobody else wants the stock or when everyone else is selling. This approach is partially true and partially false. Sometimes when everyone else is selling the stock, there's a very good reason for it, and you should be selling too. Nonetheless, contrarian theory is a valuable tool to have at hand when thinking about where and when you invest in the stock market. Sometimes investors pick up real bargains in out-of-favor stocks, but again, you must do your homework. Warren Buffett, one of the richest men in the world and probably the most successful stock market investor in history, says that people look for discounts in every area except in stock market investing. He's made his fortune by continually looking for discounts, in that the stock is trading well below its intrinsic value. His ability to find these stocks and then move into them and take large stakes has made him and many thousands of other people extremely rich. The other concept that you will hear about, the greater fool theory, takes hold usually in a stock market boom. This theory says that no matter how much you pay for the stock, you don't have to worry because a greater fool will come along and pay you even more. The problem with the greater fool theory is that eventually the market runs out of fools. At that point, people begin to sell, like the tide going out, and the market turns around and goes in the other direction. As more and more people rush to sell, a semi-panic can set in, and the entire market can drop dramatically. In the high-tech and dot-com boom of the 1990s, the greater fool theory took over with a vengeance, and people began buying stocks at prices that in retrospect were completely ridiculous. Brand new companies that had never produced or sold anything would make an initial public offering, an IPO, and people following the greater fool theory would run the stock up several 100% in a single day. Even highly intelligent, sophisticated, conservative, and experienced business people and investors got swept up in the greater fool theory and lost enormous amounts of money. Don't let this happen to you. The greater fool theory is also applicable to real estate. If you hear someone say that the only direction that something can go is up, either don't buy it or sell it as fast as you can. There's no such thing as a perfectly secure investment that has high potential returns, but no downside risk, as all the people who invested in subprime mortgages learned to their dismay. Now let's talk about financial representatives for a second. Here's an important point. Salespeople who work for stock brokerage firms are paid on the basis of straight commission. They sell exactly what they are told to sell by their superiors. The person you speak to on the phone usually knows little or nothing about the stock he or she is recommending. Their jobs are to make up to 200 calls per day and sell whatever their management has told them to sell on that particular day. Most registered representatives are not a source of investment advice. If you take their advice, you must know that you are throwing dice with your eyes closed. You are gambling with your money. A good friend of mine is a multimillionaire who earned his money over the years through hard work, savings, and investments. He's often contacted by investment advisors recommending that he invest his money into something that they are selling. In some cases, he invites the investment advisor to come and visit him personally. During this personal visit, he asks the investment advisor about the advisor's own net worth. He says that he does not believe in taking advice from people who are worth less than he is. In addition, he wants to know how familiar they are with what they are recommending. His experience with investment advisors has been consistent over the years. He finds that they know very little about what they're selling and that they have not bought any of their investment product themselves. He has never found an investment advisor who is as successful financially as he is. At the end of the conversation, most of these investment advisors concede that he would be unwise to invest with them. They go away and seldom contact him again. Now, there's a moral to this story that is important to you. Almost all the money that is made in the stock market, with few exceptions, is made by the people and companies buying and selling stocks on commission. Very little is made by the actual investors. In one 22-year study tracking the careers of 1,500 men and women, 83 of whom became millionaires, the researcher found that not a single person in the study became wealthy investing in the stock market. In fact, most of the people in the study were still struggling financially after 22 years of work, and one of the main reasons was because they had lost so much money investing their savings in stocks recommended by financial advisors. Another point to remember is when the stock market turns down or the financial market declines, the same people who are giving investment advice are often thrown out of work by the thousands. They often find themselves unemployed and unemployable, or going to work in other fields. This is not to say that there are not many fine, honorable men and women in the field of financial planning and investment counseling. It's just to say that there are also enormous numbers of people in those fields from whom it would be dangerous to accept advice. Remember, the only thing easy about money is losing it. However, if you're interested in investing in the stock market successfully, there is a lot of good advice available. Bernard Baruch was one of the most successful stock market speculators in history. He started his career as a runner on Wall Street, as I mentioned, and ended up as one of the richest and most respected Americans and an advisor to 6 presidents. In his book, Baruch, My Own Story, he gives some timeless advice for evaluating a company stock before investing in it. He singles out 3 factors. 1. Examine the real assets. Examine the assets of the company, the cash in excess of its indebtedness, and the value of its physical properties. Learn how to read a financial statement so that you can clearly understand the assets and liabilities of the company. Remember that you're thinking about paying a certain amount of money for a share in that company. You need to know exactly what it is that you are buying. 2. Ask, what does the company do? Be sure to ask, does this company make something or perform a service that people want or must have? The most important time period in considering an investment in a company is the future. The future of any company is determined by how good its products or services are today and how much in demand they will be in the future. McDonald's, for example, has been a good stock over the years because what it is selling has been in continual and usually increasing demand. And 3, study the management. Another way of evaluating a company's stock is to assess the quality of its management. This is especially important in evaluating whether the company is going to grow in the future. Today, venture capitalists, those specialists who invest in new companies, look to the quality of management as the most important single factor in determining investment success. If the right people are in charge, they'll find a way to make the company successful in most cases. Here are Bernard Baruch's 10 most important lessons learned. Failure to follow these rules has been the reason for losing money for every person who ever violated them in the stock market, including Bernard Baruch over the course of his career. Rule number 1. Don't speculate unless you make it a full-time job. Remember, every decision you make is a bet against the decision of someone else who is studying the stock market 40, 50, and 60 hours a week. Rule number 2. Beware of anyone bringing gifts of inside information or tips. The number one way to lose money in the stock market, and probably anywhere else, is to act on tips from people who really don't know what they're talking about, like taxi drivers, bartenders, barbers, and even your close friends at work. Rule number 3. Before you buy a security, find out everything you can about the company, its management and competitors, its earnings, and its possibilities for growth. Be patient, disciplined, objective, and unemotional. Take the time to investigate before you invest. Rule number 4. Don't try to buy at the bottom and sell at the top. This can't be done except by liars. When you buy a stock, decide at what price you will sell it, and when it hits that price, don't be greedy. With program and computer trading today, you can set a sell price on a stock that will be triggered automatically when it hits that price. The fact is that you will never go broke taking a profit. Rule number 5. Learn how to take your losses quickly and cleanly. Don't expect to be right all the time. If you've made a mistake and you see that the stock is going down, sell the stock and cut your losses as quickly as possible. The very best technique for cutting your losses in the stock market is called a stop loss. With a stop loss technique, you put in an order to sell your stock at 8% to 10% below the highest price at which you have owned that stock. For example, if you buy a stock at $25 per share, you would put a stop loss for $23 on that stock, approximately 8% below your purchase price. If the stock goes up to $30, you would move the stop loss up to $27.50, slightly over 8% below the highest price at which you have owned the stock. If the stock declines to this point, it is sold automatically. The use of the stop loss technique can minimize your losses if you have the discipline to stay with it. Rule number 6. Don't buy too many different securities or stocks. It's better to have only a few investments which can be watched carefully than to have too many. Diversification spreads your risks, but it also eliminates any chance that you might have for major gains if one of your stocks were to increase rapidly in value. Rule number 7 for investing in the stock market: make a periodic reappraisal of all your investments to see whether changing developments have altered their prospects. Use zero-based thinking. Always ask when you have new information, if I had not purchased this stock, knowing what I now know, would I purchase it again today? If the answer is no, that is your cue to sell. Rule number 8. Study your tax position to know when you can sell to greatest advantage. Be aware of the capital gains taxes that are applicable to your transactions. Remember that the only thing that counts is the amount that you have left after taxes. The timing of stock market purchases and sales to create capital gains and capital losses is an area with which you should become thoroughly familiar if you're going to invest in the stock market. Rule number 9. Always keep a good part of your capital in a cash reserve. Never invest all your funds. If you keep a cash cushion at all times, you'll also be in a position to take advantage of unexpected opportunities that come along. You'll also have an emergency reserve to act as a buffer no matter what happens in the marketplace. And rule number 10, don't try to be a jack of all investments. Stick to the field you know best. Usually the most successful investors are those who pick one particular industry and concentrate on becoming knowledgeable about the companies in that industry. Pick an industry that interests you so that you'll enjoy keeping current with it. Now, many thousands of successful investors have been interviewed over the years in an attempt to discover their so-called secrets of success. Here are some of their recommendations. First, if you're not a bit worried about your speculations or your investments, then you're probably not risking enough. You should have enough money invested so that it is a real concern to you. You are far more likely to make the right decision when you're emotionally involved because of the size of your investment. You're also more likely to watch that investment more carefully. Second, always take your profit too soon. Conquer greed, as Bernard Baruch says. There is a saying in the stock market, bulls make money and bears make money, but pigs never do. Third, distrust anyone who claims to predict the future, since all financial outcomes are loaded with uncertainty. This means that every investment is a gamble of some kind. No one can tell you with accuracy what is going to happen in the future with regard to any stock or investment. Everyone is guessing the very best way they know how. Now, the fourth lesson from successful investors is that when the ship starts to sink, don't pray, jump. In other words, accept the small losses cheerfully as a fact of investing life. At the very best, 50% of investments will go wrong. They will actually decline in value. they will fail to realize your hopes and expectations for them. But you can still succeed in investing if you minimize your losses on the downside so that you can maximize your profits on the upside. Fifth, luck is the most powerful single factor in investment success. Because there are no predictable patterns in investing in the stock market, for you to be successful, you need a lot of luck. A good question for you to ask is, how much of my financial future am I willing to entrust to luck? Sixth rule for financial success is never fall in love with an investment. Never become emotionally involved with anything that you purchase with the intention of making a profit. This rule also includes real estate, especially your home. Many people fall in love with their investments and are reluctant to admit that they've made a mistake. As a result, they ride them all the way down into the cellar and often end up setting themselves back by several years. Seventh, never confuse a hunch with a hope. Many people hope that a particular stock or investment is a good one. They then say that they have a very good hunch that it's going to go up. Consciously separate your hunches from your hopes, and don't confuse the two. Eighth rule is that optimism means expecting the best, but confidence comes from knowing how you will handle the worst. To put it another way, confidence springs from the constructive use of pessimism. The method that I recommend is for you to always ask, what is the worst possible thing that can happen in this situation? Always be willing to face the worst possible outcome. J. Paul Getty, at one time the richest man in the world, said that his secret for success in investing was to objectively assess the worst possible outcome of any business deal before going into it, and then to do everything possible to protect himself should it occur. This you do by putting a stop-loss order on every investment. The ninth rule is to disregard the majority opinion. Think through every decision for yourself. Don't allow your investment decisions to be influenced by anyone else. Take the time to think them through personally and then take full responsibility for each choice that you make. And the 10th rule is that if it doesn't pay the first time, forget it. If, based on the information you have, you decide to invest in a stock and it doesn't work out, sell the stock and go on to something else. Keep your ego completely out of the equation. A very wealthy man once told me, investment opportunities are like buses. There will always be another one coming along. The preceding advice is practiced by many of the most successful people who have ever invested in stocks. Remember, though, the stock market is highly speculative. It's dominated and controlled by people who are making their livings by buying and selling stock for others. And these people make mistakes every single day. There are no foolproof ways for making money in the stock market. If you're going to invest in stocks, be careful. Do your homework and watch your investments all the time. And this brings us to mutual fund investing. You see, there's only one way to invest in the stock market with minimal risk, and that is through a mutual fund. A mutual fund is a pool of money made up of the investments of thousands of individuals like yourself. This money is used to purchase a diversified portfolio of stocks. A mutual fund is run by professional money managers, people who make informed investment decisions. These are people who spend their full time in the stock market. Mutual funds are sold directly by the mutual fund companies themselves and also through stock brokerage firms, investment advisors, banks, savings and loans, and other outlets. There are thousands of mutual funds available, and they have records of performance that are all over the map. Some of them actually lose money when the stock market is booming, and others make money when the stock market is declining. Once again, this is an area where you must investigate before you invest. There are two types of mutual funds with regard to cost. The first is called a commission or a load fund. In a load fund, you pay up to 8.5% commission, which comes out of your investment when you invest your money in that mutual fund. Most of this commission goes to the person who sold you the mutual fund in the first place. This is how the fund companies compensate their salespeople. With a commission-based fund, the balance of your investment is put into the portfolio of stocks. The explanation for charging an 8.5% commission, or whatever the amount they charge, is that if the fund is well managed, you will make it all back and more in a reasonable amount of time. Sometimes you do, and sometimes you don't. There are also no-load mutual funds. These are mutual funds you can purchase through various intermediaries without paying a commission. 100% of your money will be invested for you immediately. Now, countless comparisons have been made over the years between commission funds and no-load funds. The conclusion seems to be that there is very little difference in investment return between the load and no-load funds. Both types seem to be well managed and perform very much the same. There is therefore no need for you to pay a commission when you buy a mutual fund. Your results will likely be no different in the long run, but you'll lose a substantial part of your investment at the beginning if you pay a commission, and it can take you a year or more just to get back to your original investment. Now, there are several factors you should consider when you think about investing in mutual funds. Bear these considerations in mind when you make your choices and decisions. First, past performance is seldom any indicator of future performance, except in select cases. If your mutual fund is successful, it will usually attract enormous inflows of new money. Soon, it can become so large that its money cannot be invested to achieve the same rate of growth that made it famous in the first place. By the time you hear of a successful mutual fund, it's usually too late to get into it and enjoy substantial increases in your investment. Second, there are certain mutual fund management companies that have long-term above-average records of success and growth. It's not unusual for the shares in a specific mutual fund to increase 10%, 20%, 30%, 40%, even 50% in a good year in the stock market. Often, a large mutual fund can achieve above-market returns for several years. Third, irrespective of the pros and cons of mutual fund investing, the very best place for the average person to invest in the stock market is through a well-selected mutual fund. Because it holds a diversified portfolio of stocks, your downside is limited. Unfortunately, in most cases, your upside is also limited. Most mutual funds move in tandem with the stock market as a whole. When the stock market goes up, the fund's value goes up. And when the stock market declines, they decline at about the same percent. Fourth rule for investing in mutual funds is that one of the advantages of a mutual fund, like a stock, is that they are highly liquid. If you need your money back, you can sell your shares, as you can with any stock, and get your cash quickly if you need it, usually within 72 hours. Fifth consideration, and perhaps the most important, is that mutual fund investing enables you to turn your attention to your career and your business. Once you've invested the money in a mutual fund, you can get on with the rest of your life and work activities and not think about your money again, at least in the short term. In any case, over the course of your working lifetime, you're probably going to invest in the stock market, if for no other reason than to store your money between investing it in your business or real estate or other things. So here are 2 points for you to remember, and 2 ideas for the future. 1 is open an account with an online broker and carefully invest your money, starting with a money market account and then venturing into well-chosen mutual funds. The act of investing in the shares of large corporations changes the way you look at money and business. And number 2, do your homework before you purchase an individual stock. Investigate before you invest, and then buy 100 shares in a company and industry in which you have confidence. This will give you invaluable experience for the future and will assure that you are doing everything possible to ultimately achieve financial independence.